My dear friends and investors, welcome to our monthly video on markets and investing. So what are we going to talk about today? Well, the Q1 earnings season is now well and truly over. All the results are out by the 15th of August, and we will talk about the trends in the earnings and what we should make out of it. Thereafter, we will talk about a sector about which we haven't spoken for a while, which is pharma. And then we would look at the health of the banking sector and the capital goods and infrastructure sector. But let's start with the Q1 earnings. As you know, we have been talking about and monitoring the health of the top 500 companies quarter after quarter to decipher what is happening in the economy and the most important fundamental factor that drives stock prices in the long run, which is earnings. So we come back to our favorite table. If you look at the top 500 companies and you look at the Q1 numbers, what we see is that the top line has grown by about 3.5% year on year. However, EBITDA has grown at a very handsome 31% and PAT has grown at a very, very robust 42%. Yes, the number looks very good because if you remember, Q1 of last year was a very, very tough quarter, which was immediately after the Russia-Ukraine war, where there was a massive impact on margins of companies. And if you look at the non-financial companies, which is when we take out all the financial companies out of the top 500, and if you look at X the banks, the top line is up 1%, almost flattish. But you must remember that last year there was an impact of inflation, and now that as prices are coming down, it does have an impact on revenue growth. So revenue growth is flat. However, EBITDA has grown by 27.5% and PAT has also compounded very handsomely at 38%. And therefore, if you look at the margin picture, if you still remember our previous videos, we had talked about an overall negative impact on margins of 550 basis points between April last year to December. And if you look at Jan to March, we got back 150 basis points. And now if you look at April to June, we've got back another 120 basis points, which means that out of the 550 basis points that we lost, we have got back almost half of that, which is 270 basis points in these two quarters, which is Jan to March and April to June. So we've almost recovered 50% of the lost margins that we saw for the non-financial companies in the first 3 quarters of last year. We've now got it in the fourth quarter and first quarter of this year, and which is good news. However, if you look at the 2-year CAGR, which means that if you compare 23 June quarter ending with the 21 June quarter earnings, you see a very, very healthy picture. The top 500 companies, the revenue has compounded at 21% for those 2 years CAGR, and PAT has compounded at 34%. And if you remove the banks, the PAT has compounded at almost 25% plus. And therefore, we are seeing a very, very healthy growth of earnings in India after a very, very long period of time. And as we have been reiterating, our confidence on the markets are largely based on the fact that we continue to see very robust earnings growth from a broad section of companies, whether you look at including financials or whether you look at it excluding financials. Coming to the pharma sector, if you would remember, the pharma sector did phenomenally well immediately after COVID hit, and there was a big run-up, and after that the pharma sector went into some sort of a slumber. But from this quarter onwards, we are seeing that pharma operating margins, which had peaked in the June quarter of 2021 at 23.2%, we are now back to almost 23% levels in Q1 after a gap of 2 years. And we are seeing a very positive commentary from both Indian and international pharma companies as regards to the US generics market, where it's looking like that there is no more aggressive price erosion. So the US market pricing is stabilizing. In fact, in some of the drugs, there are now shortages. Also, an interesting trend that we've seen, especially in the international large generic companies out of the US and Europe, their earnings commentary tell us that now the generic companies are stepping into biosimilars. And that's very good news, because as you know, we have a large investment in companies like Syngene, which actually benefit from spending on biosimilars. This quarter, we also re-entered Divi's Laboratories, as the severe margin compression that we had seen over the last few quarters seems to have bottomed out, and margins are starting to improve. And now we think we have reasonable visibility that every quarter from here onwards we should see an improvement in margins and top line. So therefore, as the fundamentals of the sector start to improve, we believe that it was time to increase our allocation, and therefore, while we continue to own Syngene, we've now again added Divi's back to our client portfolios. Coming to capital goods, which tells you about the health of the investment cycle in India, what we see is that the order inflows for large listed cap goods, and we've taken a couple of large representative capital goods companies, excluding L&T. L&T we know is anyways doing well, but because L&T is so big, it kind of tends to crowd out others. So we wanted to see the trend ex L&T, and the numbers tell a pretty good story that order inflows continue to be very, very strong in the first quarter of this financial year. And if you look at the outstanding order book, which is the cumulative order book of all these companies at the end of June 23, it's at an all-time high. And that gives us the confidence, not only from the perspective of investing in the sector, but it also tells you the health of the economy and the fact that both the public sector and the private sector is now spending on new capacity creation, whether it's in power, whether it's in renewable, whether it's in automation, whether it's in data centers, whether it is in transmission, whether it is in construction, we are consistently seeing that order books of companies continue to improve dramatically. And as things stand today, ex L&T, it's not just about the large companies like L&T, but even ex L&T, we are seeing a significant traction in order book, and that bodes very well for future growth, as companies only put capacity or spend when they see that the future demand is likely to be robust. Similarly, another sector which is a very large part of our economy and the indexes is the banking sector and the financial services sector. And if you look at the health, both the trend of gross NPAs as well as net NPAs, both for the public sector as well as for the private sector, you will see that over the last several years, right from 2013 right up to 2023, if you look at the trend of the last 10 years, the gross and the net NPAs are at their lowest that we've ever seen. And that tells us that the banking balance sheets are pretty strong. Not only does it have a direct correlation to say that banks and NBFCs will continue to do well, but it also tells you that the health of the sector is very, very robust. And what do you need for a strong economy? You need a very strong banking system. So if you now match what I talked about the order books in the capital goods system, which tells you that there is spending happening in the economy on new capacity creation, on infrastructure, on modernization, and if you look at the health of the banking sector, it gives the confidence that all is well as far as the economy is concerned. So earnings are strong. If the banking system is good and the country is spending on new capacity creation, I think all of this gives us the confidence that our fundamentals seem to be very sound. And obviously the markets are reflecting that. But if I were to talk about what are the risks that we see on the horizon, if there are any, all's obviously good, but we see two risks in the near future, and one of them is that food inflation continues to be reasonably high. And we obviously, all of you have read and heard about what's happening to tomato prices, but in general, because the monsoon has been very patchy and August as a month has turned out to be a deficient month as far as rainfall is concerned, there are concerns that this could stoke food inflation, and that is something that we need to monitor. Let's see how the rains in September pan out, because if September is also deficient, then this could be a little bit of a worry, and it's difficult to say whether the RBI will therefore raise rates. So far, what the RBI has said is that they are willing to overlook what they think is a temporary spike in food prices. But if that continues to sustain, maybe, and we do not know, maybe we may have to see one more rate hike. So that's one risk of deficient rainfall in August and September, and what impact it could have on food inflation is something that we need to monitor, is one of the risks that we would like to flag. The second risk, which in a way is not a risk yet, is the tremendous amount of supply of stock that we have seen in the secondary markets. We have seen a trend where promoters and private equity have used the buoyancy in the equity markets and the liquidity that's coming in to sell large stakes an exit. And while that's not necessarily bad, because it tells you that our capital markets are widening and deepening, and the process of financialization is improving, but the rate at which in the last few weeks, the kind of supply that we have seen is of a very, very different order. And if this supply continues at this rate, it will certainly have a dampening effect in the short to medium term on stock prices. So, all the liquidity that's coming into the markets and the fact that mutual funds were sitting on excess liquidity also tells us that a lot of this liquidity could get soaked up if we continue to see tremendous supply at the rate at which we have been seeing in the last few weeks. And that may not necessarily be bad, because it could quieten the markets for some time, but this is something that we think we need to monitor very closely. And I thought that it is important that I bring out these two risks in the near term that we need to watch out for. Barring that, as I've said, all indicators, whether it is earnings, the banking system, the credit growth, the investments that we are making in new capacity creation, gives us tremendous confidence of the health of the economy, and the markets are reflecting that as well. Lastly, as a proud Indian, it would be amiss if we do not celebrate the success of the Chandrayaan-3. After landing on the moon, Chandrayaan-3 sent out a message: India, I reached my destination, and you too. And it is a real proud moment for all of us Indians that India's scientific prowess and the hard work done by our scientists at ISRO has really put India in the elite map of very few countries who have been able to land successfully on the moon. And this time we've done a first, which is nobody has landed on the South Pole, and we have. But what it also tells us is that space tech is coming of age in India. And some of you would not remember, but early this year in the budget, around that there was a lot of reforms. The entire space area was opened up to the private sector. And now the world is looking at us, that the strengths that India's space sector has got. And we believe that space is not just good, obviously, from a research and in terms of what ISRO can do and study our solar system and understand the potential for minerals, for water, for hydrogen on the moon. But what it also means is that a lot of the private sector companies in various sectors, in engineering, in software, will get involved in this sector, which should expand at a very rapid pace over the next few years. So it also means good business. As you all know, India has always been launching satellites for other countries because we are so cost efficient. But if we can land on the moon at a fraction of the cost of what other countries have been able to do globally, it is a sector which holds out a lot of commercial promise as well. And we should be able to create a very competitive ecosystem of component suppliers, service suppliers, and and the private sector which will gain from the growth of space exploration. So with this, and feeling very proud to be an Indian, we come towards the end of this month's communication. Until the next month, thank you.